Hello. So welcome to part two of lesson 9 on money and banking. And just before we start, first I want to talk about what I'm expecting from you in terms of work. So I uploaded a homework last night, and I expect that on Wednesday, I believe, at next Thursday, on at midnight. And I've put a question on Backpack, which will be due as normal Tuesday at midnight. So obviously you have to do a question and 2 answers. But I'll send you an email all about that, and really just keep in touch if you're not getting anything or not understanding anything. You notice that everything's on Learn. I'm putting new tabs on the left-hand side. All the homework's going to be there in online homeworks, and all these videos are in videos. And just try and carry on as normal, and interact with me. Come to office hours at 5 till 6 every night on Zoom, and send me emails. It's all a very interesting time. And I just suddenly sort of was struck by something this morning. If you notice, over this last week, 6.6 million people have filed for unemployment. 6.6 million people are unemployed. And obviously last week it was 3.3 million applied for unemployment. And it suddenly struck me that after we'd said about the definition of unemployment, I think the week before spring break, we discussed the definition of unemployment, which obviously means someone who is unemployed but actively seeking work. Suddenly struck me that obviously in this context, are people actively seeking work? And I don't know, and I imagine that the government has done this, but I would imagine the federal government has had to put some sort of stipulation that during this time, people will not be expected to actively seek work, because obviously that means you're going out and you're not socially isolating and all these types of things. So this is a very, very complex time. The economy has like gone, into some sort of deep freeze for a while. I actually got my dream job sort of last week. I was like so happy, but then suddenly the university that gave it to me has put on a hiring freeze. And so, it can be quite sort of devastating, that type of thing. But we hope that this is only a temporary thing, and things will rise up again in the summer. So obviously, in terms of however sort of worried you're getting, just believe that the economy is going to pick up once the health side of this is sorted out. Okay, so back to banking. I'm going to share my screen. And here is so obviously a very interesting time for sort of bankers and the whole banking industry. Let's have a look. So I've started from the beginning. So hopefully you looked at the video by Mr. Clifford, and you saw how banks create money. And they, so banks, even of themselves, even outside, like next week, we'll look at how the Federal Reserve can expand the money supply. But obviously, Mr. Clifford was showing that through giving out loans and through the whole process of fractional reserve banking, banks create money. And so ultimately, they keep a certain amount of your money. You deposit it, and they keep 10%, and they're in a position to loan out sort of 90%. And obviously, then someone else can put that money into another bank, and they'll own, the bank keeps 10% and loans out 90%. And through all this, money is being created. Over and above, as we'll see next week, the Fed expanding and contracting the money supply. So just think about at the moment, Do you think banks are giving out loans at the moment? Do you think people are taking loans? Probably not. And so you can see that obviously a situation like this where we're going into recession becomes a double whammy for the money supply, because suddenly, because banks are not actually creating money because they're not really giving out loans, the money supply is contracting sort of naturally. We can say that's happening naturally. So it's in a sense, we're sort of living through these things that we're seeing. Okay, but hopefully you've got the idea of fractional reserve banking. This idea that, you know, when you deposit money into a bank account, even into your checking account, you know, the bank is only keeping a certain amount of it, and they're giving out loans with the rest. And, you know, that's ultimately how banks make money. You know, a load of money just sat in a vault, you know, is not making any money. But a load of money that's being lent out is making the bank money, because they're being able to charge interest on it, you know. And so technically, you know, with a 10% required reserve ratio, if the federal government or the Federal Reserve says, you know, a bank has to keep 10% of your money, theoretically, they could be, you know, through the deposit multiplier that Mr. Clifford was talking about, and that could be multiplied 10 times. You know, money could be being created off that money, you know, by 10 times. But in reality, that's not really happening. Usually the real world multiplier is about 1.6 times during normal periods. Maybe in the boom, you know, remember we were talking in January, February that we were still in a boom. Maybe that was bigger, you know. But even if you think 1.6 times, you know, if you had some sort of machine that could suddenly, you know, turn, you know, $1 of money into $1.6 of money, you know, that would be a wonderful machine. You would make, you know, fortunes out of it. So even a 1.6 multiplier is still creates a lot of liquidity. Liquidity means when there's a lot of cash around in the system. You know, banks can expand the money supply by giving out loans. And if in a boom situation, people are taking more and more loans out, banks are prepared to give out more and more loans, that multiplier can go up. And you know, ultimately, why isn't it sort of, you know, why aren't banks really out there? You know, especially these days, often banks want to keep a little bit of excess reserves, so they've got some security, and you know, and maybe they just can't find the loans that they know they're going to make money out of, and you know, and when things get difficult, you know, the money multiplier can go down. You know, in 2007, 2009, when the financial crisis hit, banks would just stop giving out loans, you know, because they're wanting to, like in a recession, like you as an individual is probably thinking, okay, we've got to get through these next few months. We've got to save our money. We're not spending it. Banks are the same. You know, when a recession hits, they're looking to their own security. And as we'll see later on, I think probably next week, you know, trying to get banks to actually lend out money and get the economy moving is often what the Federal Reserve is trying to do when they do their quantitative easing or expand the money supply. So in general, let's just conclude about, you know, the high street banks before we start looking at the wider financial system. So we can assume that the real world deposit multiplier is greater than 1. So we can assume that when banks gain reserves, when you put your money into the bank, you know, they're making new loans. They're thinking, oh, we've got some new money. Let's try and make some money out of this. Let's try and make some loans. And so in a situation when a lot of loans are being given out, there's a lot of confidence in the system, the money supply expands. But when, like, for example, you're taking your money out of your checking account, there's, people aren't saving as much. It's a difficult situation. Also banks are going to reduce their loans, and the money supply is actually going to contract. So this adds to the sort of the the confidence and the growth in a boom time, but it also adds to the sort of negative effect of a recession in a difficult time. Okay, so maybe you've been asking yourself one sort of question. If I'm putting in my money and the bank is only keeping 10% of it, what if I want my money out? It's probably okay if I just want my money out, but what if a large amounts of people want their money out? And that's what used to happen. And that used to be called a bank run, when everyone suddenly thinks, I want my money. I want my money. I put my money in the bank. I want it. And then they would say, sorry, we've only kept 10% of it. We can't give it to you. And often in the 19th century, you had this phenomena where banks would just say, sorry, we can pay you 10% on the dollar of your money. We haven't got it. It's gone. And this obviously, because, when the rumor that this happens has gone around, that means in any type of insecurity, everyone will be trying to get their money out of the bank. And so really, there will be very little confidence in a banking system when there are bank runs. So what has the government, or what has the central bank done to sort this out? And the big thing in the US is the Federal Reserve System. And a number of countries, in England we have the Bank of England, there's obviously the Bank of France, Bank of Spain. These are central banks that are supported by the government, but are usually independent from the government, that basically oversee the financial system. So behind all these banks, these high street banks, probably the bank that you're involved in, is the Federal Reserve System, the central bank. And here it is. I believe that's Fort Knox, or one of these places where they used to keep gold. They don't do it anymore. There's Alan Greenspan there at the top, very, very famous. He was said to have created the boom that led to the Great Recession. This lady here is Janet Yellen, who was the chairman of the Federal Reserve a couple of years ago. Me and my wife actually saw her and her husband. Her husband actually is a Nobel Prize winning economist, so they're probably the ultimate power couple. But yeah, these are the people that run the Fed, and these are very, very powerful figures. So why does it exist? When did it start? What does it do? So we'll be looking at this week, and we'll be looking at this more completely next week. Okay, so if you imagine it, the whole concept of a bank run, so let's have you say, the economy has gone on a downturn. Suddenly people think, there's a few bit of rumors around, the banks are not doing too well. So, at the thought that, and actually even the suspicion that you might not be able to get your money out of the bank, what is everyone going to do? They're going to just try and get their money out of the bank, before the bank runs out of money, And so a few people start doing it, and then everyone starts thinking, okay, I'm going to start doing it. Oh, I best start doing it. And so that creates contagion. And then, suddenly banks start selling their assets and, having to withdraw loans and doing all sorts of things that add to the difficulty, add to the general sense of unease. And obviously that then affects the economy even greater. They always said in the early 30s, one of the real reasons for the Great Depression was that there was just a massive failure of local banks. There was just so many bank runs that actually, some say that was actually worse than the initial effect of the Wall Street crash, the fact that the banking system collapsed. Because obviously, you know, that's where you keep your money. That's where you get your loans. That's where all your financial business as a person on the street, as a consumer, is done through a local bank. And so this idea of the Federal Reserve coming along, you know, that had a lot of money, basically became the backstop to all these sort of bank runs happening. And they acted as a lender of last resort, promising to make loans to banks in order to pay off depositors. And so basically, if the people know that whatever happens, there's this big, you know, big uncle, big brother, you know, in the background who's going to bail out the local bank, they're not going to start withdrawing their money. So it breaks this negative feedback loop. And that was the whole idea of the Federal Reserve and, you know, the central bank. And so, you know, it all started in the, you know, because of in the late 19th century and early 20th century, the United States experienced several bank panics, and it was quite a difficult thing. In 1914, the Federal Reserve System started, the Fed, and, you know, they started making these discount loans, charging a rate of interest called the discount rate. And like at the beginning, as I was saying on Tuesday, the Federal Reserve gave $2 trillion to high street banks, basically, you know, and the Federal Reserve released that money, and everyone's saying, oh, you're giving all this money to bankers, this is just terrible, what about the man on the street? But they were doing that to shore up the banking system, because if that goes, everything goes. You know, I'm not a pro-rich banker person, but I realize how important the banking system is, you know, and it's very, very important that there is cheap money in the system, so they can lend out money, they can keep, you know, local businesses afloat, they can, you know, people can go in and get loans, people can get credit to see them through this sort of difficulty. And so that's the whole idea of the discount loan and the discount rate. Now, in the 30s, you know, so they started this system in 1914, but it hadn't been sort of, you know, really nailed down by the 30s, you know. And in the early 30s, you know, many banks were hit by bank runs, and the Fed decided to not make loans to banks, and 5,000 banks failed. And, you know, obviously these were probably in small towns, and so, you know, the whole economy of that town was crushed, you know. And looking back, lots of economists say that it was actually the bank runs and the collapse of local banking systems in the early 30s that actually really made the Great Depression as bad as it actually got. And so, you know, the federal government, you know, because the New Deal, you know, we can't look at it that deeply. You know, maybe you do it in your other classes, but, you know, Franklin Delano Roosevelt's New Deal in the 30s really, not only did it help at that particular time, but it significantly changed the US and how it ran. And so they created the federal, what's it? Federal, I can't see that. Let's have a look. So federal something, you'll have to see the D Insurance Corporation, FDIC, and you know, Federal Deposit Insurance Corporation. And that insures deposits in many banks up to a limit, you know, which is 250,000. So obviously if you've got more than that in a bank, but chances are if you've got more than $250,000, you're not going to have it on a high street bank. And so this you know, this is a government guarantee that helped limit bank panics. And so that, you know, so there is law, there is a strong federal system behind banks now, behind high street banks, and even other things that are not quite banks, as we'll see. And so that really limits bank panics. And even in 2007 to 2009, when the whole financial system was on the verge of collapse, very few banks, actually experienced runs. The only ones were the ones that had very, very rich customers and stuff like that, and were doing all sorts of sort of very shady things. Okay, now, with every reaction, there is another reaction. So from every action, there is another reaction. So as we see, because, fractional reserve banking, there is there was a reaction of bank runs. Now the Federal Reserve has really said we're going to back up the banking system. Do you think the bankers were thinking, oh, that's very nice of the Federal Reserve, we'll play it really cool, just to support the government? And for a long time they probably did. But as we'll see in the 70s and 80s, the banks started thinking, well, the government's going to bail us out whatever we do. So we can do all sorts of interesting and exotic things with money. And because, the government is going to bail us out. And that's where the whole revolution in banking occurred in the 70s, 80s, and particularly the 90s. When my sort of mother and father split up, we went to a small village just north of London, very, very, to live with my grandfather. And it was, quite a well-off village. Often people were bankers, and I used to see all these sort of bankers when I was young. I think, they're such boring people. They used to play golf and wear suits and go on the train to London. And it was just seen to be a very, very boring world. But obviously, I left university in 1992, and everyone was all the big banking companies, the merchant banks, the hedge funds were really trying to recruit. I went to a very good school, Cambridge University. They wanted to get all the people graduating, and wanted to get them into banking, because the banking industry was really expanding and exploding, and there was all these new things going on. And obviously being a banker in the 90s and 2000s was very exciting, because you were making so much money. And let's see how they were making that money, and what was the fruit of that. So ultimately, I'm going to try and explain to you what happened in the financial crisis of 2007, 2009. I realize to you guys, this is a bit like ancient history. You're probably very, very young at the time, but obviously this really has affected the modern world in a lot of ways. And so ultimately, what we were talking about earlier was the high street banks, the commercial banks. And basically what they did was they took deposits from the consumers, and they kept a certain amount of it, but the rest they gave out in loans. That was their job, and that was just very normal sort of banking. That was just being a boring banker ultimately, But in the last 20 years, two things, 20 years probably like now, 30 years now, two things occurred in the financial system. Firstly, and we'll look at this in the next slide, banks began to resell many of their loans rather than keep them until they were paid off. So we'll look at that in a second. So, and then, because this first thing, this reselling of loans became a thing, suddenly other things that, other than commercial banks, other organizations started to develop that thought, ooh, we can actually get into this. We can get into this market, And so they became sources of loans. And we'll see how that's happened. So ultimately, what happened? So basically, you would go to your bank, you would get a mortgage, they would keep that sort of mortgage contract, they would keep it in their bank vault, and you would pay them off. over time. So that was an asset to the bank, and they were just making money out of it, you know. But sometime in the 70s, someone came up with the idea. I don't know who it was. It was a very, very clever idea that's saying, okay, well, this mortgage, this loan is actually a security. You know, you're getting money back, you're getting interest back. And so this could actually be traded on the stock exchange. And so the whole process of securitization came into the market. And this was, you know, imagine it. You know, you've been getting this bit of paper you've been keeping in your bank vault for, you know, for as long as living memory. That's what banks did with mortgages or loans or car loans. But then suddenly said, well, we can actually make money out of this. We can actually sell these on the stock exchange. So it's a little bit like suddenly realizing all the receipts you've got from what you've spent, you can actually make money off them. You know, suddenly, bang, all this money has come into the system, you know? And so, you know, these started to trade. And suddenly there was just all this money in the system, you know? And so basically, think about it. You know, and these are very, very tricky things, and you know, we'll keep going over them. And if you ever need to talk to me about it, come to my Zoom office hours and we can discuss it. But this is, you know, obviously it is fascinating, you know, how they did this. So what happened is, you as a household, you get, you know, your mortgage or your car loan or some sort of business loan, and you are paying interest on that loan, and over time, over a period of time, you're paying back that loan. Now, obviously, the financial institution is bundling those loans. You know, firstly, it's getting the money from them, but it's bundling those loans into securities, and investors on the stock exchange are purchasing these securities, you know. And so the bank is then collecting the loan payments from the household, collecting a fee for processing those payments, and sends the payments to investors. So if you think about it, yeah, you know, the bank is not getting that little dividend from the initial loan, but it's actually been able to sell the loan off. So they've made all the money they want off that loan. So can you see, you know, it's something that takes a little bit of a while to see, but when you see it, you just realize they were just creating money out of thin air. You know, bits of what, you know, like, as I say, making money out of your receipts. You know, it was a, you know, incredible revolution in banking. And that was the whole process of securitization. And so in the 90s and 2000s, all these things that weren't really commercial banks started thinking, well, you know, we could get into the action here. We could start giving out loans. Not only will we make money off those loans, we'll actually be able to sell those, you know, bundle those loans into securities that people will buy on the stock exchange. So we can just make money out of thin air, really. That's what it was. And that's what it still is, you know. And so this whole idea of investment banks, you know, the big investment banks that were coming along, you know, sort of Morgan Stanley's, your Lehman Brothers, you know, these big things that were just making serious money, you know, in the 90s and 2000s, that's what you wanted. That's the sort of job you wanted in London, because these guys had money just, you know, just in ways that you just thought, you know, it just seems so much more than anyone else can earn, you know. And then, or money market mutual funds started getting into the act, and hedge funds started getting into the act, you know. And so they were providing loans, and they became what was, these firms became part of the shadow banking system. So it became very, very interesting. So obviously these
commercial banks, these high street banks, are pretty regulated. It's very clear what they can do and what they can't do. But obviously these new organizations, these new firms that are rising, there was nothing that was actually, stopping them from doing ultimately whatever they wanted. These hedge funds, they made more high risk investments, money market mutual funds, they're doing things that are a little bit shady. Investment banks, sometimes are trading in all these sort of mortgage-backed securities, but they weren't particularly, they didn't have the moral parameters, the legal parameters that high street banks had. And so what started to happen, I don't know if you've ever watched The Big Short. I'll be suggesting a few clips from The Big Short soon, but if suddenly you can make money off loans, do you think that these people in investment banks and commercial banks and hedge funds thought, oh, yeah, it's great, we're making making a bit of extra money on these loans, we're packaging them up as securities and selling them on. We're happy with that. We're happy with the amount of money. You can only have one Ferrari. You can only have one house in the south of France. Do you think that's what they were thinking? No, that's not what big money people think. They're thinking, how can we make more and more and more money? And so what started to happen was, traditionally, and because everyone trusts the whole idea of the housing market, the whole mortgage market, people thought, right, we'll just get more and more mortgages, and then we can package them up and sell them on the stock exchange. And so at first they started thinking, well, we want good mortgages. But after a while, they started thinking, well, they don't necessarily need to be that good as long as we can sell them. And even, obviously some people were just totally immoral. They said, well, as long as we can sell them, if they collapse later, it doesn't matter. Or some were saying, because the US housing market is expanding, even if we give bad loans, they'll still be able to sort of pay off things because the economy is so good. And so traditionally, the mortgage market was always divided into what was called prime loans and subprime loans. So prime loans were the really good, you knew people were going to pay and stuff like that. But subprime were a little bit risky. And, we won't talk about that. There's always some sort of, there's always a whole racial element to that. Loans in minority areas were seen as risky. Whether they really were or not is often seen, that's just seen as a very sort of racist policy. But, let's just think about it in prime and subprime. So, say for example, in 1997, it was about 6% of mortgages were subprime, and then it started going down because of the recession in 1999-2000, and it started to creep up. And then in about 2004, suddenly, there was just all these really just like terrible sort of loans being given out because people knew they could make money out of it. I know friends of mine who are just homeless people virtually. You would go into banks and they'd come out with £5,000 loans, not because they would, banks were desperate to get the loan out because they knew they would get some return on it. But they knew more than that. They knew they could sell that loan on the open market, on the securities market. And so up to 2006, 2005, 2006, it was nearly 20% of those loans were subprime. Really, really bad. Very, very, absolutely no credit history, absolutely no collateral backing to these loans. They could just collapse at any moment. And so this was what was the prelude to what happened in 2007. Again, I really recommend you watch this video about, basically how, people have created these things called mortgage-backed securities. And it's a little bit like when a dodgy salesman sells you a load of, vegetables, and there's really nice stuff at the top, but at the bottom it's all rotten, like if a big like, ton of vegetables, but the bottom half is all rotten or something like that. And it was the same with these mortgage-backed securities. They would give these AAA mortgages at the top, and people would say, oh, that looks really good. But at the bottom would be all these subprime mortgages that really everyone knew were going to collapse eventually. So watch that YouTube video. And so, so what happened in 2007, 2009 is that the shadow banking system, because obviously they were the ones that were really doing a lot of this sort of dodgy, very tricky stuff, and really investing in subprime mortgages, selling a lot of subprime mortgages on. And because these were much less regulated by the government, that they, that they weren't even actually technically backed by the FDIC. They were highly leveraged. Leverage means when you're basically operating on borrowed money, just trying to make money off borrowed money, which is obviously what everyone does to a certain extent. But when it's highly leveraged, sometimes you're keeping 1% of someone's deposit, and trying to then loan out 99%. That's very, very high leverage. It's very, very insecure, and so there's an awful lot of risk. And so they were making a lot of money, but it was all based on very, very shaky foundations. And so in 2007, when there was a little bit of constriction, there was some rumors going around that the housing market was in trouble. The shadow banking system started to crumble, and so first, an investment bank, Bear Stearns, avoided bankruptcy by being purchased by JP Morgan Chase, and then in 2008, Lehman Brothers actually declared bankruptcy, and their clients pulled the money out. So the federal system was in a bit of a situation. Did it back up this shadow banking system or not? Because legally it didn't have to do it. But even though the commercial banks weren't angels during this time, but it was these shadow banks, these shadow investment banks, these new investment banks that started in the 90s or so, started to collapse. And when Lehman Brothers failed, basically the whole system went into panic. The whole securitization system ground to a halt. Suddenly, banks stopped making loans. It was all, it was a really freaky time. I lost my job in 2008. Loads of people lost their job. It was really, really heavy. Suddenly, you had this credit crunch. Banks were, refusing to give out credit. Suddenly, the whole system looked like it was being shaken. And so the Federal Reserve was put in a situation. It didn't have to back up a lot of these investment banks, but in 2008 it did, and it took vigorous action with the Troubled Asset Relief Program. So basically, it gave funds to banks in exchange for stock being all these subprime loans. So basically, the Federal Reserve gave money, and the banks gave them these just really awful loans that probably weren't ever going to get paid off. The Federal Reserve started to give loans to, discount loans to very, just investment banks, to the shadow banking system, and it started buying what's called commercial paper for the first time since the 30s. So it's really taking any sort of bad assets off the commercial banks' books and putting them on the Federal Reserve books. And so it rescued the banking system, and that stabilized the financial system. But economists and policymakers still debate their wisdom, you know. And ultimately, you know, what did it cost you? Obviously not you, but maybe your parents. That, you know, it was $500 billion of a bailout to these, you know, greedy bankers, you know, because of what they had done, you know. And you know, this was taxpayers' money, you know, the pockets of hardworking American people. Rich and greedy bankers were bailed out, and some would say, and a lot of people say, and I'd probably ultimately say, you know, probably what would have happened if they hadn't done that could have been a lot worse. But, you know, I know people that made vast amounts of money in 2003, 2004, 2005, and they weren't asked to pay that back. You know, it was actually the American taxpayer that had to bail out the banking system. And, you know, watch this video. So it's about the aftermath of the Big Short. And, you know, the terrible thing was, you know, what were these big investment banks? Was the shadow banking system broken up? And the reality is, no, it wasn't, you know. And so, you know, when you look, I really recommend you watch The Big Short, and you see what happened there. You see the greed that led to this, you know, collapse of the financial system virtually. When you see that, you realise that, you know, and how it was bailed out by the federal government, and you think, oh, you know, that wasn't maybe that good. And there was a period, especially in the Obama administration, where there was a lot of brakes put on the banking system. There was a lot of attempts to stop that happening again, but since the sort of the presidency of President Trump, you know, obviously he's much more into the free market, and he's into, you know, just freedom for financial institutions. But he stepped in and really rolled back a lot of the things that stopped the banking system doing the same things as what led to the Great Recession in 2008, 2009. And so there's all sorts of rather shady dealings going on in the stock exchange and within the financial system that are now legal again. Especially the lowering of capital requirements, stress testing within the system has gone down. These are all quite complex sort of things, you know, basically bringing down a lot of the regulations, you know, defunding research and monitoring of the financial industry. So people are just free to make money, and there's a danger that if they collapse, they'll be too big to fail, and the taxpayer will have to bail them out. Okay, so that's a very, very small overview of a very, very fascinating system, the banking system, the financial system. Obviously, if you've got any questions, email me or come to my office hours. I'll be there 5 to 6 on Zoom tonight and 5 to 6 on Zoom tomorrow night. Okay, but if you can, watch The Big Short. You've obviously got plenty of time in your social isolation. And if you've got any questions, or, you know, you've got any issues with technology or things like that, please get in touch. Please keep me in the loop, and we'll work out how to sort of get all through this together. Okay, stay safe and healthy.